Welcome back to Smart Stock Sam, the channel where we cut through Wall Street noise and find the real trade. And before we dive in, I need to ask you something important. What if I told you there is a stock right now? A stock most retail investors are chasing with pure adrenaline and zero understanding. That is walking directly into a hidden mechanical trap this week? Not a rumor, not a gut feeling. A precise, documented convergence of three separate institutional forces that almost nobody in the retail world is currently talking about. That is exactly what we are uncovering today with SanDisk, ticker SNDK. This is your warning. The hidden trap in SNDK stock this week is real, it is verifiable. And if you are planning to trade this name without understanding what we are about to walk through together, you are flying completely blind into a storm you cannot see coming. Here is exactly what we are covering in today's deep dive. First, the jaw-dropping financial transformation that has turned SanDisk into one of the most explosive and controversial stocks in modern market history. Second, the business model innovation that has Wall Street's smartest analysts violently disagreeing with each other. Third, the specific options market mechanics, the institutional dark pool data, and the hidden corporate event that are all conspiring simultaneously to trap this stock inside a very specific price range for the next 5 trading days. And finally, your exact actionable playbook for trading it this week without getting caught on the wrong side of an algorithm that does not care about your portfolio. Stay with me every second of this video, because by the end, you will understand this setup better than 95% of the traders currently holding positions in this name. To understand why this week is so uniquely dangerous for unprepared traders, we first have to understand the almost incomprehensible magnitude of the run SanDisk has already executed. When SanDisk spun off from Western Digital, it debuted at just $27.89 per share. Today, it is trading near $1,980. That is not a typo. That is an advance of more than 7,100% from a single starting point. Let me ask you this. When was the last time you saw a legacy hardware manufacturer, a company that literally makes physical memory chips, go from $27 to nearly $2,000? Because historically, that almost never happens to businesses in the commodity memory space. These companies have brutal boom and bust cycles. They do not have parabolic re-ratings that defy gravity. But SanDisk has done exactly that. And the reason comes down to one single word: artificial intelligence. The market has completely repriced SanDisk from a cyclical commodity memory provider into an absolutely non-negotiable piece of global AI infrastructure. This is not speculative sentiment. It is reflected directly in the actual reported numbers, and those numbers are genuinely extraordinary. SanDisk just posted a year-over-year revenue increase of 251%, bringing in $5.95 billion in a single quarter. But honestly, the headline revenue figure is almost secondary to the real story buried inside that earnings report. Data center revenue, the pure, direct AI driver, surged 645% year-over-year. 645. The catalyst is NVIDIA's Vera Rubin hardware launch, which has created a genuine global storage supply crisis that has nowhere near enough capacity to satisfy demand. SanDisk is sitting directly in the center of that crisis, charging premium prices because their largest customers simply have no viable alternative. But here is the single number that should make every serious investor stop and reconsider everything they thought they knew about this sector. Gross margins have expanded from 22.7%, an acceptable but ordinary hardware number, all the way up to 78.4%. In the world of physical manufacturing, a 78% gross margin is the absolute holy grail. That is what elite software companies achieve. SanDisk is achieving it on physical silicon chips. That means nearly every new dollar flowing through the front door is dropping straight to the bottom line, and that extraordinary shift is what has forced Wall Street analysts across every major bank to completely tear up their old spreadsheets and start valuing this company from scratch. Now, here is the uncomfortable question that every disciplined investor should be asking right now. Hardware businesses have always been fundamentally cyclical. Prices surge, capacity investment accelerates, supply eventually catches up, and then margins collapse brutally. So how is SanDisk actually protecting these extraordinary new profit levels from the inevitable supply response that history guarantees is coming? The answer lies in what management has branded the new business model, or NBM, and the strategic logic behind it is genuinely impressive. Instead of selling memory chips on the open spot market where prices fluctuate daily based on raw supply and demand, SanDisk has essentially forced the most powerful hyperscalers in the world, the companies racing to build AI data centers at a scale never seen before, to sign multi-year contracted supply agreements with minimum revenue obligations built directly in. SanDisk has locked in $42 billion in guaranteed prepayments from these customers. $42 billion. That single fact completely transforms the company's revenue visibility from unpredictable to extraordinary. They are no longer selling a commodity on a spot market. They are renting out contracted critical infrastructure, and that strategic pivot is the core engine behind everything we are seeing in the valuation today. But despite all of this undeniable strength, Wall Street is experiencing what I can only honestly describe as a violent ideological civil war over how to actually value this company. On the aggressively bullish side, Bank of America holds a target of $2,100. Mizuho is at $2,200. Cantor Fitzgerald sees $2,900. And Susquehanna holds the current street-high target of $3,250 per share. These analysts are arguing that the AI data center infrastructure build-out is only in its absolute earliest stages, and that SanDisk's contracted locked-in revenue stream makes it far more comparable to a premium software infrastructure company than any legacy hardware player. But then you look directly at the opposite end of the spectrum. Morningstar, one of the most methodical and rigorous independent valuation firms on Wall Street, is sounding a serious and sustained alarm. They are calling this entire rally a massive structural bubble and holding firm with a fair value estimate of just $1,000 per share, half of where the stock is trading today. The stock currently floats in the center of this battlefield at $1,980, with both camps absolutely convinced they are the ones who have it right. When the most credentialed people in the entire financial system disagree this violently about what a company is fundamentally worth, that is almost always a sign that the true risk profile is dramatically more complex than the price chart alone would ever suggest. Does that make you at least a little nervous right now? Because it should. The raw valuation metrics make that case even harder to ignore. SanDisk is currently trading at a trailing price-to-earnings ratio of roughly 64 times. At 64 times past earnings, this stock is priced for nothing less than absolute flawless perfection at every single turn. One missed quarter, one delayed hyperscaler contract, one word about slowing AI capital expenditure from any major tech CEO. Any of those events alone could trigger a severe repricing. The forward price-to-earnings ratio is a more digestible 23 to 27 times, factoring in the massive guaranteed contracted revenue. But even that still represents a 70% premium to historical estimated intrinsic value. And the ultimate risk hanging over this entire thesis remains the same one that has ended every hardware supercycle in history. Eventually, global NAND supply catches up to demand. When that happens, and every cycle in this industry says it will, those 78% margins are going to compress. The only real debate is the timing. The people who know this company from the inside appear to already be positioning for that scenario. Institutional ownership sits at 87.11%, roughly 129 million shares, reflecting genuinely massive smart money conviction in the long-term AI thesis. David Tepper's Appaloosa Management, one of the most respected and feared macro funds on the planet, initiated a brand new position in the first quarter, lending serious credibility to the high-conviction story. And management recently urged shareholders to outright reject an unsolicited mini-tender offer at $1,150 per share, signaling they believe the company is worth dramatically more than that level. But here is the red flag that you absolutely cannot afford to dismiss. The C-suite has been actively selling. The chief legal officer recently offloaded $1.04 million worth of stock. Both the executive vice president and the chief technology officer have been selling shares directly at all-time highs. Could this simply be standard pre-scheduled tax selling? It is possible. But heavy, repeated insider distribution right at the very peak of a parabolic curve is a pattern that has burned retail investors too many times throughout market history to treat as noise. It always warrants disciplined caution, regardless of how genuinely compelling the long-term story sounds. Now, whenever a heavily debated, heavily covered stock pushes to all-time highs, the retail crowd starts screaming about a massive short squeeze around the corner, and I need to extinguish that narrative right now before it costs somebody a significant amount of real money. The data simply does not support a mechanical squeeze scenario. Short interest is currently just 9.2 million shares, representing only 6.31% of the total float. More critically, the days-to-cover ratio sits at a microscopic 0.87. That means if every short seller simultaneously decided to buy back and close their entire position today, it would take less than one full trading day of average volume for every single one of them to fully exit. The borrow rate is just 0.27% annually, essentially nothing, meaning shares are extraordinarily cheap and easy for institutions to maintain short positions. Dark pool volume has been elevated, running between 43 and 50% of total exchange volume. But the deep underlying liquidity here means a mechanical short squeeze simply is not the catalyst you should be building a trade around this week. Do not let that narrative mislead you. So, if short sellers are not the catalyst this week, who is? To answer that with precision, we go directly into the options chain, and this is where the short-term mechanics become genuinely extraordinary. For the June 18th options expiration, we are staring at a textbook gamma pin setup. There are over 1,719 call contracts concentrated at the $2,000 strike. A perfectly round, massively psychological resistance level that every trader on the street is watching simultaneously. On the downside, 790 put contracts anchor the $1,850 and $1,900 strikes, creating a defined floor. Because of this enormous concentration of open interest on both sides, market makers are going to be mechanically and relentlessly hedging their books throughout the entire week. As price drifts upward toward 2,000, they will sell the underlying stock to remain delta neutral, creating an artificial structural ceiling. As price drops toward 1,850, they will buy, creating a mechanical floor. The options market itself becomes a cage around the price action, and that cage does not care about your bullish thesis or your technical breakout setup. But the gamma pin is only the first layer of the trap this week. The second layer is something that the overwhelming majority of retail investors are completely unaware of, and it is honestly the most critical piece of analysis in this entire video. Right now, Western Digital is in the active process of exchanging 1.03 million shares of SanDisk for WDC stock. But here is the detail that changes everything. The exact exchange ratio is not predetermined. It is calculated entirely based on the 3-day volume-weighted average price, known as VWAP, covering June 16th through June 18th. During that precise 3-day window, which overlaps perfectly with the option's expiration, highly sophisticated institutional arbitrageurs are going to be aggressively managing intraday price action using advanced algorithmic trading systems. They need this stock controlled and range-bound, not breaking to exciting new all-time highs, not collapsing on heavy volume. Perfectly predictable, so they can mathematically optimize their exchange ratios. That is an institutional force dramatically more powerful than any retail buying wave, and it will be operating inside this stock every single hour of every single trading session across those 3 days. When you overlay that algorithmic suppression directly on top of the technical picture, the full setup crystallizes. SanDisk remains in a powerful and genuine long-term uptrend, trading comfortably above its 50, 100, and 200-day moving averages. That foundation is not in question, but immediate overhead resistance is cemented at the all-time high of $2,021.65. Structural downside support sits near $1,865, and look at what the momentum indicators are telling us right now. The 14-day RSI is hovering in the high 60s, firmly in borderline overbought territory. The MACD is printing a negative histogram at the precise moment the stock is testing historical resistance. Buying momentum is decelerating at the ceiling. That is not the technical fingerprint of a stock that is about to launch explosively higher over the next 5 trading sessions. Here's the complete synthesis. This week, June 15th through the 19th, SanDisk is caught inside a 3-way institutional collision. First, heavy technical resistance at the all-time high. Second, a massive options gamma pin anchoring price near the $2,000 psychological level. Third, direct and deliberate algorithmic suppression driven by the Western Digital VWAP pricing window. These 3 forces are converging simultaneously to create what I am calling the trapped range. Does anyone seriously think this stock is breaking cleanly to $2,200 this week against all 3 of those forces at once? Is there any realistic scenario where it collapses all the way to 1,600 while those put contracts are providing a massive institutional floor? What we are actually looking at is controlled, range-bound, high-volatility oscillation between well-defined mechanical levels, and that is precisely the environment where disciplined, prepared traders generate real, repeatable returns while the undisciplined ones get completely chopped apart. Here is your exact playbook for the week. Our primary execution setup is a range-bound Iron Condor, or a Mean-Reversion scalp. On the short side, your entry zone is $2,000 to $2,020. If price spikes aggressively into that zone early in the week, you initiate short positions or sell call spreads using the gamma wall and all-time high resistance as your structural protective shield. On the long side, your entry zone is $1,850 to $1,865. If the stock dips into that zone, you buy or sell put spreads, anchored by the heavy put support and the structural daily floor. For both sides of this trade, your profit target is mean reversion back toward the VWAP median, roughly $1,930 to $1,950. That is where the algorithms are mechanically pricing this stock to settle, and that is where your trades need to resolve. No professional trade exists without clearly defined, non-negotiable stop levels. Short side from the $2,000 zone, your hard stop is a daily close above $2,030. That level completely invalidates the all-time high resistance and signals that a gamma squeeze may have ignited, potentially launching price toward 2,100. Long side from 1,850, your hard stop is a daily close below 1,830. That breakdown destroys the options support floor and signals that insider distribution has overpowered the bullish narrative entirely. Respect those levels as absolute and sacred, because in a mechanically managed market environment, violating your stops is how ordinary weeks turn into devastating losses. Before we wrap up, I want to be completely and genuinely transparent with you, because transparency is the foundation this channel is built on. Nothing in this video constitutes financial advice of any kind. I am not your financial advisor. I do not know your personal financial situation, your specific risk tolerance, your investment timeline, or your personal financial goals. Every single thing we have discussed today is strictly for educational and informational purposes only. Options trading and short-term speculation carry substantial and real risk, including the very real possibility of losing more than your initial investment. Please always conduct your own thorough independent research and consult with a licensed, qualified financial professional before making any investment or trading decision. Past performance of any stock, including SanDisk, is never a guarantee or reliable indicator of future results. Please trade responsibly, size your positions appropriately, and never risk capital you cannot afford to lose entirely. SanDisk is one of the most genuinely extraordinary business transformations in recent market memory. The AI infrastructure thesis is real and well documented. The $42 billion contracted revenue pipeline is real. The margin expansion to near software levels on physical hardware is real. But this week, this very specific 5-day window represents one of the most mechanically complex and deliberately managed institutional trading environments this stock will face all year. Respect what the data is telling you. Trade the range with discipline, and protect your capital above every other consideration. Now here is the question I want every single one of you to answer in the comments below, and I genuinely want you to think carefully before you respond. If SanDisk manages to close cleanly above $2,030 on heavy institutional volume this week, despite the gamma pin, despite the WDC VWAP algorithmic suppression, and despite every mechanical force we have analyzed, does that mean the institutional suppression simply failed and the real breakout to 3,000 has just started? Or does it signal something far more dangerous happening beneath the surface that most traders will not see until it is too late? Drop your answer below right now. I read every comment, and the sharpest responses may very well make it into next week's full analysis video. If this research gave you a real, tangible edge today, do me one quick favor. Hit the like button right now. It takes you 2 seconds, and it tells the YouTube algorithm that this level of institutional-grade research deserves to reach more traders who need it. And if you are not yet subscribed to Smart Stock Sam, what exactly are you waiting for? Hit subscribe and turn on your notifications. Setups this precise and this time-sensitive come and go fast, and you absolutely do not want to be the person who misses the next one. If you want to directly support this channel and help us keep producing deep dive, research-heavy content at this level, you can send a super thanks directly through YouTube right on this video. Every single contribution from this community genuinely means everything to us and directly fuels more content like this. And one final thing before I let you go: Smart Stock. Sam now has an exclusive membership community, and if you are truly serious about leveling up your trading and investing to the next tier, this is where you need to be. The link is right below this video in the description. Come join us, because the best trades in any market are always made with the best information available, and this community exists to give you exactly that edge. Trade smart, stay disciplined, protect your capital, and I will see you in the very next one.